What are you seeing right now, just in your deal flow?
The way we think about it is there are companies that are seeking to compete in a new way with the incumbents. And then there are companies that are looking to sell to and serve the incumbent base, sort of enablers versus disruptors type of concept. And we've got positions in both, really. In insurance, it has a lot to do with how do you lower the cost of insurance by being more efficient? That tends to be a major thesis that comes through on the disruptor side. But at the same time, there are companies that are trying to sell to the incumbent saying, here are solutions that you can embed into your existing scale and be more efficient. A lot of the early money went to the disruptor side of things, but there are far more companies on the enabling side, I would say.
Dan, thank you for being here. Really appreciate the time to have a conversation with you about your experience in venture capital and working with corporates. You and I met, I think it was 2018, when Highline Beta was working with American Family, looking at building new businesses adjacent to American Family's core. We ended up together spinning out a company called Relay Platform. You were involved in that a little bit. And then that company ended up being acquired in 2022 by AtBay. And that was, quite the interesting ride. And maybe we'll talk a little bit about that. But that's how we originally met. Today, you're managing director of American Family Ventures, which is actually a multi-LP venture capital firm. So really, that's an important point for us to dig into, because some folks might think of that as just a corporate venture capital where you have one LP, the company. I know previous to this, iteration of American Family Ventures, it was a CVC with one LP, and so we can talk about that evolution. I think is just really interesting, just because you have so much broad experience on that front. So maybe we'll start there. Origin story of American Family. You've been there a long time, investing and evolving and growing into this multi-LP structure.
Yeah, well, good to see you again, Ben, and nice to see you, Marcus, and thanks for having me. Yeah, you're right. When we met in 2018, we were just in the process of making a transition from a single capital partner in American Family Insurance, where we had started, to something that represents a little broader swath of the insurance industry in the United States. So the origin story for us at American Family Ventures was I was working in strategy at American Family Insurance, and for your viewers who don't know American Family, it's a top 10 insurance carrier in the U.S. We're headquartered in Madison, Wisconsin, where I live, and we've been in business 98 years now. So back in 2010 or so, I was thinking in a strategy role about how does a company like that, really built for stability and with a long history of success, how does a company like that get involved in new things in a more effective way? And it just the concept of American Family Ventures came to me really by accident, because I was having partnership discussions with large and small companies about what can we do together. And, by large, I mean companies like Toyota, how do we want to work together on auto insurance, but also companies on the, the startup end of the spectrum that had raised $50,000 and were really just getting started. And some of the startup conversations, they really had to hit me on the head with it. It was probably a dozen companies where we were trying to form some sort of partnership around data or around customer experience or something. And a few of them would come to me as part of the contracting process and say, we would love to be able to use your logo on our website. Is that okay? Or we'd love to use your logo on our pitch deck. By the way, we're pitching for a Series A financing or something, and we've got this partnership. Would you ever think about participating? And it was always no. That's not really what we do. And then one day it was like, I don't know, like maybe the 10th time that happened. It's like, why aren't we doing that? These yeah. We're already working with, right?
Yeah.
And long story short, we started making some of those investments, candidly, using a little bit of a loophole in the corporate investment policy that said, essentially, as an insurance company, we have to invest our capital in this, this particular set of ways, 99% of the time. But there was a 1% exclusion that said we could do more strategic type stuff. That was really what we needed to do. So we did a handful of those types of investments, found that there's a place for this, found that fairly quickly it just engendered a new type of conversation around what a big company can do and how we can explore in a way that casts a wider net and also hopefully pays for itself through the value of the investments that we're making. And ever since then, it's been, every year we try to evolve it and get a little better at it, a little bigger at it. We did the first two funds just from American Family. So Fund 1 was a $50 million fund, and Fund 2 was $150 million. And at that time, by the time we did Fund 2 in 2016, the insurance startup environment had just exploded, and people started talking about insurtech. And I started getting calls from other carriers, insurance carriers, saying, "How did you get this? Now it was like 6 years old. Like, how did you get this thing set up? What did you talk to the board about? How did you hire for it? How did you do?" A lot of the questions that you guys get on, startup studio construction. What are the lessons you've learned? How do we do it right? So some of those conversations turned into, well, why would you want to replicate it? Why would you want to? Why don't we just work together on the next stage of our evolution? And Fund 3 for us in 2019, so a bit after we met, was the first time we did a multiple carrier fund. We had 13 other parties, and then Fund 4 in 2022 was we doubled the size of it and doubled the size of the carriers, and that's really been our focus is growing that footprint, growing that network, and trying to be useful and trying to be smart, like every other VC tries to do.
And obviously through that evolution, you really built off the success of delivering financial returns and kind of growing that fund size. Have you noticed anything different in the ecosystem with respect to the interface of just American Family and the ecosystem more broadly?
Yes, I think so. I mean, when we started, part of that original presentation to American Family's board back at the very early days was, I'm an ex-consultant, so like frameworks and slides and stuff, like it's I used to write letters to my wife in PowerPoint, like it was I kind of moved off of that, but
we can talk more about that if you want, Dan. Like, you can pull up one of those people's old PowerPoints.
Yeah, the less the better about that. But the framework that I had in mind at the time was there was a lot of talk in like the corporate venture world, and I was doing a ton of reading back in, this is now just about 15 years ago, but how to do corporate venture, how to do it right, what to avoid, how not to be, overbearing in the approach that you take to this. But one thing that kept coming up is how do you balance financial returns with the strategic interests that you have in the space, and my solution to that was a 2x2 chart that said, where the axes on the 2x2 were financial and strategic. And for me, it wasn't, hey, we're 50% financial and 50% strategic, or we lead with strategic and have the financial. It was every, of those four quadrants, every investment that we make, we believe is satisfying the financial aspect of it, which is, can you make 10 times your money over a 5 to 7 year period? Something that's a return that's commensurate with the risk, but also has to satisfy that it's providing some strategic option or some strategic visibility, something strategic about it. And the belief was, or, the way I was thinking about it is that everything we do has to be in that top right quadrant when we write that first check. And some investments will stay in that top right quadrant where you kind of win on both fronts. But and those are great. And we've had some, go that way. But others will move away from the strategic and just become financial. Some will move away from the financial and just become strategic. And then others will return neither. You'll end up with no outcome. And it was important to me to talk about, first of all, like, you can kind of win in those three ways. But it was important to me to talk about, if we're going to embark on this type of activity, we need to end up with some, we're not aiming to have some in that, total zero type quadrant, where you don't get a financial return and don't get a strategic return. But we have to be comfortable with having some of those types of outcomes. Because if you're not comfortable with it, or you don't end up with any of them, you're probably not taking enough risk, and you're probably not thinking aggressively enough. And I got a lot of nodding heads about that. And that was really the approach. That's evolved from that very simple dynamic to, lots of ways that you can define what strategic means. Mostly it's become, we invest in areas that we know in advance are areas of interest for our limited partners, for all of those different carriers. They all want to understand more about AI. They all want to think about, distribution, claims advancements, new opportunities across the value chain. And we kind of leave it at that. We don't pre-qualify whether something is specifically strategic, and we don't seek to get special terms for, strategic benefits. It's more just like the activity itself is strategic. And then we underwrite the financial side, because as you take on more money and you take on money from more partners, the notion of fiduciary duty becomes stronger and stronger. So you have to focus first on the returns, but you do it in a way, and then you evolve it from there to say every investor in the pursuit of financial returns has to have some angle, has to have some edge. And for us, the vertical focus backed by people who are in that industry is hopefully the thing that provides us some edge. It helps us evaluate complicated insurance concepts a little bit in a little bit sharper way, and it helps us be useful after the investment. So it's the two are not really at odds the way that some people were saying back when we were getting started. They should really work together. The idea of strategic and financial.
Dan, with just thinking about taking on other capital and stewarding capital from partners, how has that changed in this evolution, the timeline with respect to delivering financial returns compared to before?
The thing that gave us confidence to be able to do that is to make that expansion, is that during Fund 2, we established some processes and really a mindset of transferring what we're seeing in the market to our capital partners, to American Family at the time. And so we created some staffing around that. We created some events. We created a handful of methodologies to make sure that what we were seeing was useful. It wasn't just stopping with us. And it wasn't very hard for us to expand that, to say, like, a lot of the programs that we built and the mindset that we had and the processes were totally expandable and transferable to that broader base. So we have engagements that include all limited partners. We do events that way. We have events and engagements that are sort of limited to individual partners. Each one of them has their specific interest areas, and all of them have a lot of commonality around the things that they want to see. So we just, as the fund has expanded, the team has expanded, and we've been able to kind of staff to that new expectation.
Right. And when you make an investment in a startup, they know that you've got a whole host of LPs behind you in this industry, and you're making very specific investments that are vertically focused. Do those startups try to go through you to get to those LPs and say, Dan, open the doors to all those LPs because I want them as customers or partners? So, back to that strategic, you're not required for there to be some kind of partnership, certainly with American Family out of the gate, to unlock the investment. You guys are just making investments. But I would imagine those startups are trying to hustle with you or through American Family Ventures to get to LPs.
Oh, sure. Yeah. I mean, that's one of the things that really all VCs talk about is almost to the point of being like a cliche, is what's the value add that they provide.
Value add. Yeah, there it is. Yeah, ding, ding, ding. Value
add. Came
add.
out. Yeah, once again.
We were going to say it. We teed it up for you. So
yeah, thank you. I mean, yeah, exactly. Like it's kind of a thing. And to the point where, like, you make a stupid comment in a board meeting, and it's like hashtag VC value add or whatever.
Yeah, yeah, exactly.
But yeah, certainly they look for that kind of business development, connectivity. And then what's nice is the limited partners are looking for that too. So it's an easy connection to make. Both sides want to meet each other. We do a lot of that, sort of very intentionally for the portfolio companies and for the LPs. But one thing that I've noticed is it's not really just about the portfolio. The pipeline matters too. And so, we'll make a lot of introductions. It's, I looked at this once for every company, for every portfolio company where we'll make an introduction, there's probably 10 pipeline companies that we'll make introductions for as well.
Right.
So,
that you're not investing in, right? You're deciding it's not a fit for the fund, but could be a fit based on what LPs are looking for from a partnership perspective.
Exactly. Yeah. Maybe it's too early for an investment or, or whatever outside of our scope or something. But we think we can still be useful to all parties, because the venture capital business is really just like a network business. And so you want to be seen as a good partner. You want to see as someone that people want to talk to. And there's a few ways that you can do that.
Do they ever send you deal flow, the LPs? Because I'm sure every one of them is getting hit up by startups all the time, right? From a partnership perspective or a sales perspective. So do they ever send you deal flow and say, Dan, we've got a partnerships team or something on our side. They're looking at startups. We think they could be interesting, or even from American Family as well. Does deal flow come that way where there's already a notion of some strategic fit?
Yeah, I mean, that's one of the ways to, Marcus, he asked, and I didn't get to it because I was rambling on and on. But that's one of the ways that this space has evolved. So it doesn't. I mean, to be clear, it doesn't happen nearly as often as the other direction. Like most of the time, we're in market talking to startups, and we send through. But there've definitely been occasions when someone is at a conference or someone's working with someone as a partner and they say, you should take a look at this. And we love it when that happens. I mean, that's kind of the power of the network. It happened to me yesterday. One of our friends who runs strategy for one of our limited partners says, hey, you should talk to this person. And it's great when that happens. We have a couple portfolio companies that happen that way. So it's fantastic.
And Dan, how's the portfolio construction changed now, getting into Fund 4 and having all these limited partners involved in kind of supporting kind of the overall interface?
The portfolio construction, we are able to cast a little bit of a wider net. So because there are so many more partners, back to that original framework of sort of what's strategically in scope is now wider. An obvious example is American Family Insurance doesn't have a health insurance business. And so, we would, back in, 10 years ago when we were just investing for American Family, when we saw health insurance businesses, it was like, well, I don't know if we can be useful here. I don't know if this is really a great fit for us. But now we have companies that are in that business. And so that sort of thing is a little bit wider scope for us. And again, they're thinking about artificial intelligence. They're thinking about, efficiency across their value chain, just like any other insurance company. And so there's definitely commonalities. But so that's one of the things that shifted. The other thing that has shifted is there are just so many people who come from the insurance industry that, I mean, you tell me if this is what you're seeing as well, but there's, relative to 10, 15 years ago, the startup playbook, the startup, concept, just the level of familiarity with what a startup is trying to do and how you can engage with it is much higher than it used to be. So a lot of our early programming was just like, what is a Series A or a Series? We would talk to people about like, who are you talking to? When you're talking to a Series A company, what are they trying to do? And that familiarity is there now. Like it's so in the effect on the portfolio, to your question, is you end up with people coming out of the industry to form startups at a much higher rate than you used to, because there's more money there. There's more sort of proof points that you know, and playbooks to see how you can do it. So, and that's good within the insurance industry because it's a sort of a complicated industry. So having people from the industry form companies is a welcome development for us.
What Ben and I are seeing a lot of right now too in that kind of portfolio construction is the balance of AI being applied to maybe use cases with respect to digital transformation in the core, but also some going a bit more bolder, looking at, beyond the core, AI applications. What are you seeing right now just in your deal flow? You seeing a lot of these applications and deal flow for the core or looking beyond?
The way we think about it is within the insurance context, and I suppose within any industry, when you think about the startups, there are companies that are seeking to compete, maybe in a new way with the incumbents, and then there are companies that are looking to sell to and serve the incumbent base, and sort of enablers versus disruptors type of concept, and we've got positions in both, really. I mean, we see it as our job to make some investments in companies that are trying to be in insurance. It has a lot to do with, how do you lower the cost of insurance by being more efficient? That's tends to be a major thesis that comes through on the disruptor side. But at the same time, there are companies that are trying to sell to the incumbents saying, here are solutions that you can embed into your existing scale and be more efficient. And compete that way. So, yeah. So I don't know that there's been a significant shift. A lot of the early money went to the disruptor side of things, but there are far more companies in terms of company count on the enabling side, I would say.
Easier to sell to the big dogs on the street, I guess, than it is to try to beat them up.
Maybe, I don't know. I mean, it's hard to sell to anybody. It's hard to sell to big companies.
That's fair. That's true. Yeah, I mean that's very true. I don't. Yeah, that's a good point. I don't know which one maybe is easier. I still think maybe selling in is still easier than trying to disrupt. Just when you just think about pure scale, so you just think about American Family, top 10 insurer, that your size as an org, not on the VC side, or some of your LPs will just be gigantic organizations compared to tiny startups that are attempting to disrupt versus trying to sell in.
Yeah, that's right. One of the things we like, I mean, to the point that like the sales cycle takes a long time in the insurance industry, like a lot of big industries. One of the things we like on the enabling side are companies that want to serve the insurance market, but maybe that's not the only market that target. And so they can get up to speed. They can get some initial traction and build out their business by selling to industries that may buy a little bit faster than insurance. And then sometimes we see it as something that we can do is help introduce them to a new vertical in the insurance market and help open that up. And that feels like that's a very doable path for us and for our partners, to say that we can help one of our LPs be the first insurance company to work with, some company that's been working in the, property space or something like that. That I think that's useful.
How's the team evolved, from Fund 1 to Fund 4 in kind of supporting your initiatives?
Yeah, the team has grown a lot. I mean, I think back to those very early days, it was just 2 of us, and then it was 4 of us, and then it was 8 of us, and now there's 27 altogether. It's just as our it's great. And the other thing, people have come and gone, and some people have left to start businesses, some people have left to start funds. Like anything that's been going for 15 years, you're going to have a bit of turnover. But I'm where we are right now as a team is a lot of people have been in the roles for quite a few years, and I talk about VC being a network business. It's also the cumulative experience of making investments, sitting on the board, seeing them go well or not go well. Like it really does start to add up, and having some level of stability and the sort of overall maturity of the team. Every year that goes by, we gain 27 years of experience or something. So it's been nice to see how that works. The the way we're structured, there's of the 27, 13 people are making investments. And then we have, I think it's 6 people on that strategic transfer or sort of engaging between the portfolios and the limited partners. And then we have, financial operations and sort of technical operations and some support on there. But we're like a lot of groups of our size now, we're sort of balanced between investing and a lot of the support and transfer functions.
But that's a decent sized team, 6 folks that are focused on trying to connect the dots between the companies that you're investing in and your LPs. I mean, their job is to just create value between those two groups, right? Because your LPs are not the ones making investment decisions. They've given you the capital to make those decisions. You make those decisions, and then you're shopping the company around is maybe not quite the way to describe it, but then the clock is there to say, how do we create more value to grow our investment in these startups that we've put money into?
Yeah, that's exactly right. And I don't think it's not very different from other firms. I mean, they often have some teams that are doing kind of broad-based business development or events or whatever it is, trying to kind of expand the network. In our case, the premise that we raise money under is pretty clear, that we're going to be, specifically valuable to our, as that point of connection. And so we need to make sure that we deliver on that promise. Plus it helps drive investment returns. And so it's,
Of course. Well, that's the way I think about it. Like it's a out of self-interest to connect those dots, right? That's not goodness of our heart. We're making an investment in a company because we believe in it. Now, if we can help them get a customer or a partner or some level of distribution or whatever it is, then we are, back to, joking. We can joke about value add, but if we can actually genuinely create value add, that's a good thing.
Yeah. One of the things we've been thinking about lately on that, within that function, is improving the readiness on both sides. And, historically we've just kind of like played it as it lies. The LPs have some variability as to how they're organized around innovation, how they're staffed, how they have budget. I mean, you see this, I'm sure, as well with your partners. And similarly on the startup side, there are seed stage startups that have never billed anyone before, and they're not ready for enterprise level scale. And then there's others that don't need us at all to make those connections because they have scaled sales teams or whatever. And so one of the things we've been thinking about is how do we we're a more valuable partner the better both sides of those of that market is. And so are there investments we can make with our LPs to help clarify what their innovation intentions are, or help them evolve their processes, learn from each other, and how do we get the startups? It sounds sort of, I don't mean to be cheeky, but like, how do we help them navigate what could be a 15-month sales process, in an effective way?
Yeah, I think those that have never done it before are really, especially if you're moving them from, industry A into like a different industry into insurance, and then saying, guys, this is how this industry works. This is how you have to be ready for it. I mean, it does take 2 to tango here. So we need both sides understanding what to expect from the other side. I would imagine broadly on the innovation front with LPs, you must see a variety of things, whether it's them sharing pain points with you or opportunities that they'd like to explore, or level of sophistication of those LPs when it comes to innovation internally, or that interface or connectivity to startups, the readiness for it. I would suspect that's sort of all over the map.
It is. Yeah. I mean, they all have one thing in common, which was they decided to make an investment into us, and they have expectations of us. But you're right. There are some that are explicit. They say, we want to see opportunities in these 3 areas, and anything other than that, don't waste our time. And then there are others who maybe haven't defined those areas, and what they look for is just come in and just start, just start like rapping at us basically. Just go like you just come in and just start talking, and we'll let you know when you say something that makes any sense. And and knowing which one is which is kind of important for us because it sort of aligns expectations. But um, and then you look back at the end of each year or every couple of years when you think about the cycles, like are we being useful? Are sort of mutually, are we achieving our objectives, and other things we need to do? And like everything else, you just try to make improvements every year that goes by.
And Dan, I mean, you have such a unique position and experience of just seeing the evolution of this corporate venturing model. How you've co-invested with traditional VCs changed? And now having multiple, corporate LPs involved in the deal making. I'm curious just from your lens, just what you've seen.
That's a great question. Because it has changed a lot. When we first got started, I was speaking for myself, but other members of the team, we were all extremely sensitive to the notion of CVCs, because a lot of the talk at the time, and this is like think about 2012 or something, there was a lot of talk about you don't want to take money from a CVC because and it was kind of a blanket statement, but I think about it, the heart of it was you need to be careful about how they act, and you need to be careful as a founder about, are they taking terms that would diminish your outcome in some way? Maybe it's a right of first refusal or exclusivity within your industry, and or when, in the case of as it happens often, and certainly over the last couple of years when there's been a bit of a pullback in venture and capital's been harder to find, if you have a corporate investor with intentions that are maybe less directly financial, and there's a situation in which the insiders need to fund a bridge round or something like that, is the corporate investor going to take advantage of that situation and try to be misaligned with the rest of the group? That was a lot of the talk in the 2012, and I remember thinking, we're going to design a bunch of our approach to be in opposition to the sort of common complaints about CVCs. You really don't see that much anymore. I mean, it feels like
complaints. You mean you see less of that pushback against CVC and maybe the baggage that comes with it, or the strings.
You just don't see it as much. I mean, I'd be curious to see what you guys see, but for me, it's like every now and then you'll have a founder who talks about, who has this notion of like there are, tier one VCs, and then there's tier two VCs, and then there's corporate VCs or whatever. And it's like, that to me is like, that's sort of a strange hierarchical view. I mean, you want to look for an investor that has a perspective on the space and is able to add some value to you. And you see I just haven't really seen many examples of long-term VCs doing it from a corporate platform that that have wildly out of market approaches.
Well, I mean, I'll say, I think we've seen everything under the sun. You probably have as well. We've seen VCs behave poorly, whether they were corporate VCs or not. Right? Like, we've seen what you would consider tier one VCs abandon ship. We've seen corporate VCs, and I think some of those terms you're describing, rights of first refusal, or often it's have a strategic relationship locked in first before we can unlock the money. So, and then if that goes sideways, the corporate VC is maybe less interested. So we've seen all of that, but across the whole VC spectrum, you can't just point at one sort of subgroup and say, oh, that's the group that's worse than this other group from a behavior perspective or approach or lack of value add perspective. And we've seen the positive too. Corporate VCs creating tons of value, or what you would call second tier, whatever VCs creating tons of value. So that's where I think you're right. The sort of notion of, it's not a one size fits all, where you can sort of paint, all corporate VCs or all of this type of VC with the same brush. It just doesn't work that way.
It comes down to the individual, the professional behind it. And I think, again, you've earned, the success of what you've been able to build and continue doing fund after fund. And the reputation matters regardless if you're a corporate VC or a traditional VC or a family office. But, we've seen a lot more, I think, again, looking at corporate venture studio models, partnering, not being competitive with other corporate VCs. And so we see a good confluence of a lot of these models, but it always comes down to like the core values and the ability to deliver value off these platforms, right?
Yeah, that's right. And that sensitivity that my team has had over the years is it just has a different flavor now. Like back then, it felt like a chip on the shoulder. Like we're not that kind of corporate VC, or we're not a CVC, whatever. And then we went through what was a deliberate and not easy transition into taking additional capital from within the industry. We were again sort of sensitive to say, well, we've transcended this corporate VC notion, but at the same time, we still take money from the industry, and we still work for our parent company, like whatever. Like you could call us. The way I think about it is, my like if you can imagine like a blended family, almost like, right. It's like these folks are half sisters or half brother. Well, no, it's all just it's like what you make of it. It's and I don't know that probably is not worthy of keeping into the podcast here, but it's like there's just whatever, we're CVCs or we're not CVCs, like we are and we're not, and it really has to do with the individuals and the individual situations. And
yeah, I mean there aren't many models. I don't know that there are many models like yours though, where you're taking capital from other corporates that at the corporate level might be competitive. But broadly speaking, do you think corporate venture capital? Are you seeing more corporates interested in that? Do you think as the sort of reputation, let's say, of not being problematic in deals lowers, do you see more corporates getting into it, wanting to invest? I'm sort of curious about where you think broadly that in the industry is going in terms of just, well, corporate innovation and corporate venture capital being a component of it.
Yeah. I think from sort of mid 2022 to maybe mid 2024, it was kind of a reset from what was maybe like an overabundance of capital period, and peaking in 2021. So I think that reset and it almost like a shakeout of some companies won't be able to raise the next fund, or some companies moved away from the venture strategy during that period of sort of a capital pullback. I think that's the dominant framework through which I look at the venture industry right now. And we're seeing signs of capital coming back into the market, which is good. The M&A market opening back up a little bit and expectations around IPO. So that to me dominates more than, whether corporates are engaging in this in different ways or not. Navigating that market cycle is something that we've been very focused on, and I think everyone has been trying to get through. So we'll see what happens next. I'm optimistic, but we'll have to find out.
Yeah, I definitely have no idea. So I've stopped trying to predict the future. Honestly, I just focus on the things I can focus on: building businesses, raising capital with corporate partners and founders. So I not great at the future prognostication part of the business.
Now, has that affected the studio business as well, and the sort of incubation
It does.
concept?
Yeah, of course. I think it's I mean, we experienced the same thing you were experiencing, but of course at a different stage, right? Like you guys are investing later stage, we're building companies from zero. But we still need those companies to raise capital beyond the capital we're providing. So often for us, that's angel investors. At the super early stage, you incorporate a company, we put in some money, some, it can be co-investors that are angels, but these companies have to graduate out of that. And we're trying to build venture profile businesses. So, the 2022, 2023 being difficult after things sort of crashing a bit. Yeah, it's just harder to raise capital. So in our model, we just shift a little bit, try to stretch things out a little bit, build businesses that maybe aren't focused as much on the venture capital raise part of things, keep the company surviving a little bit longer at that very, very early stage. So I think we're seeing the same things you're seeing in terms of overall warming up. Again, in our model, we're often working with big companies, right, and helping them innovate and spin new startups out. And so the venture capital part of that is also an interesting piece. Do they have a CVC? Will that CVC invest, or is it perhaps too early stage still, for their mandate? What do cap tables look like with a corporate partner? So those are all the sort of things we're working on. But generally, I think we see the same things you do, which is it's warming up a little bit, and that's nice. Of course, we're at the very beginning, so the exits are still many, many years away. So who knows what 5+ years look like? And that's the part that I'm like, I can't predict that anymore. I'm not going to try.
Well, you try sometimes, Ben. Come on. I mean,
I do. Yeah,
yeah.
yeah,
I know how you roll.
yeah. So that's fair. Like sometimes trying to predict it, but not. I'm probably not good at it. Is what I'm trying to say. That's a long-winded way of saying I'm not good at it. Pretty good at building companies from scratch. Not so great at predicting the future.
Yeah. Tell me about it.
All right, Dan, thank you so much. We really appreciate your time. Great conversation. I think what you guys are doing as a multi-LP venture capital fund, having started as a CVC originally, is rare. I don't know of any others like that, but it's super fascinating to walk through the journey you've been through, look at how you're connecting strategies from those LPs to the investments that you're making, and just really appreciate your time. So thank you for having this conversation with us.
Yeah, well, great to see you guys, and thanks for having me. And we'll see you out there.
Thanks, Dan.
Absolutely. See you, Dad.